Okay, so I'm going to preface this video with the understanding it's based on a couple of factors. And number one, how the U.S. has had the privilege of being able to create the modern day financial system as a result of the Bretton Woods Agreement of basically 1945 to 1947. Now, it's my belief that the United States has abused this privilege, and that'll flow outward as we move forward from this point in time. But another factor that we need to understand is that the United States administration right now is motivated by two factors. One is greed, and you're going to see that factor with greed, how that's operated or manipulated by operation by Scott Bessent, Howard Lutnick, and Jameson Greer. Secondly, we have an issue of ethnic cleansing. It's hidden as an immigration problem and cleaning up and fortifying the immigration. And that's spearheaded by Stephen Miller and the administration through a paramilitary group called ICE, created by this administration. So, from my point of view, the United States is not acting with a moral compass that's aligned straight due north. The U.S. administration under the present administration is operating with no moral compass whatsoever and acting without compunction. In this video, we're going to discuss how Japan's near zero interest rates have enabled the yen carry trade, which has allowed Wall Street and London financial institutions to borrow cheaply and fuel speculation across global markets. Drawing on the work I study under Stephen Keen, this live stream examines how the carry trade contributed to asset inflation, the surge in AI-related investments, and why. I'm not sure we're going to get so much into the why, but you should be able to understand that from the content of this video, why the unwinding of this long-running financial strategy could have major consequences for the global economy. I'm using an AI-generated video I found online, which poignantly portrays the topic at hand. I've watched it from forward to back in order to verify the content. It expresses what I'd like to portray here in this live stream. So, without any further ado, let's get into it. Let's move into it.
So Japan just quietly stopped doing the one thing that's been holding your portfolio up for a decade. And here's why that lands on you. A big chunk of your stocks, your 401k, the whole AI rally, it was partially built on cheap Japanese money that got borrowed and shipped over here. Now Japan wants it back. And there's one number from one Monday last year that shows you exactly what that looks like when it starts. The cheap Japanese yen became the hidden fuel behind the American technology boom. Wall Street borrowed it to gamble on the future. Warren Buffett borrowed the very same yen to buy something much older and much safer, cash. Two opposite bets built on one currency. And right now, in real time, the Bank of Japan is testing which of those bets was smart and which one was just lucky. In this video, we will examine the Mrs. Watanabe phenomenon and then discover that she never actually existed. We're going to trace exactly whose money paid for the rise of NVIDIA. And we're going to lay out coldly what happens to your retirement account if Japan decides it wants its money back. No moral judgments. Nobody here is a hero, and nobody here is a villain. Just interests, incentives, and a few very large numbers. Let's begin. August 5th, 2024, a Monday. In Tokyo, the selling starts before most of America is even awake. By the closing bell, the Nikkei 225 is down 12.4%. That is not a bad day. That is the worst single day the Japanese market has seen since 1987, since the crash your parents remember. And here is the strange part. Nothing broke in Japan that morning. No bank failed, no factory burned, no war was declared. The panic didn't start in Tokyo. It started in the wiring underneath the entire global market. And to understand what tripped that wire, you have to stop looking at Japan the way the news tells you to look at it. Now zoom out, all the way out. For most Americans, Japan is a story about decline, an aging country, a lost 30 years, debt piled higher than almost anywhere on earth, a museum economy that peaked in 1989 and never quite woke up again. If that's true, answer me two questions. Why did the Japanese stock market just hit an all-time record high, a level it never reached even at the peak of its famous 1980s bubble? And why did the most patient, most conservative investor alive, Warren Buffett, quietly pour tens of billions of dollars into that supposedly dying country? To understand any of this, you have to understand one number, the price of money in Japan. For most of the last decade, that price was zero, sometimes less than zero. The Bank of Japan did something no major central bank had dared to do for long. It pushed its interest rate below zero, a policy called negative rates, and it clamped a lid on longer-term borrowing costs, too. The official goal was to fight deflation, to force money out of hiding and into the economy. The side effect was more important than the goal. Japan became the cheapest place on the planet to borrow money. Not cheap, free. Now think like a professional, not like a saver. If I can borrow a currency at zero, and there is somewhere else in the world paying 4, 5, 6%, I have a machine. I borrow where it's free, I invest where it pays, I pocket the difference. Repeat until something breaks. That machine has a name, the carry trade, and Japan built the biggest one in history. For years, it hummed along quietly. Then Japan's own prices started rising, and the machine's foundation began to move. Let me give you the timeline, because the dates matter. In March 2024, the Bank of Japan raised its interest rate for the first time in 17 years, ending the era of negative rates. That's a confirmed official fact. July 2024, another hike, and they abandoned the cap on long-term yields entirely. January 2025, 0.5%. December 2025, 0.75%. And this time, the vote was unanimous, which for a cautious central bank is a loud signal. Then, June 16th, 2026, 1 full percent on a 7-to-1 vote. And here is the number that should stop you. The yield on Japan's 10-year government bond has now climbed past 2.5%. That is a level Japan has not seen since the 1990s, since before some of the engineers building today's artificial intelligence were even born. Free money, it turns out, was not a law of nature. It was a policy, and policies end. For years, Wall Street had a nickname for the Japanese carry trade. They called her Mrs. Watanabe. Mrs. Watanabe was the picture of the small Japanese saver, a housewife in Osaka watching her bank account earn nothing, deciding to send a little money abroad to chase a better return. A charming image, a folk character for the trading floor. Now here's the reveal. The real Mrs. Watanabe was not a housewife in Osaka. She was a hedge fund in London, a trading desk in New York, an institution borrowing not thousands of dollars, but billions in yen through complicated currency swaps most people will never see and never hear about. That's the thing you have to understand about this money. Most of it never showed up as a normal loan on anyone's books. It lived in the plumbing, in derivatives, off balance sheet in the dark. Which means measuring it is genuinely hard, and I want to be honest about that. So here are the estimates, and I'll label them as estimates. The Bank for International Settlements, the central bank of central banks, put the visible, on-the-books carry trade at roughly 40 trillion yen going into the 2024 crisis, about $250 billion. That's their estimate. Then they added the hidden hedge fund positions built through currency forwards, and that pushed the number up by another 160 billion or so. And Morgan Stanley, a private estimate now, not an official one, suggested the total web of these trades ran north of $500 billion. $500 billion of borrowed Japanese money hunting for yield. So where did it go? Some of it went into U.S. government bonds, but a great deal of it went somewhere far more exciting. It went into American technology, into the handful of enormous companies driving the artificial intelligence boom. Look at what happened while that money was flowing. NVIDIA, right, the company selling the shovels in the AI gold rush, crossed $1 trillion in market value back in May 2023. By July 2026, it was worth $5.05 trillion. Not a typo, $5 trillion. The NASDAQ rose more than 26% in a single year. The S&P 500, more than 20. Now, I'm not going to tell you that cheap yen caused all of that. That would be dishonest, and the earnings were partly real. But I'll tell you what the professionals understood. Free Japanese money was one of the hidden engines under the whole thing. It was leverage. And leverage doesn't care what it buys. It only cares that the cost of borrowing stays low. For years, it did. The yen stayed weak, the money stayed cheap, and the machine printed profits. Until one Monday, it didn't. Come back now to August 5th, 2024. Now you have the tools to see what actually happened. The trigger was small on paper. The Bank of Japan raised rates by 1/4 point. At the same time, a weak American jobs report landed, spooking traders about a U.S. recession. On their own, minor events. Together, they lit the fuse under $500 billion of borrowed positions. Here is the mechanism, because the mechanism is everything. The yen started to strengthen, fast. For a carry trader, a rising yen is a death sentence, because the yen is the thing you owe. Your debt is suddenly getting more expensive by the hour, so you sell whatever you can to pay it back. You don't sell because your tech stock is bad. You sell because you need yen now. The exchange rate tells the whole story. The dollar had bought over 161 yen on July 10th. By August 5th, it bought under 144, an 11% move, which in the world of major currencies is a small earthquake. And the selling fed on itself. There's a beautiful, brutal detail here. The market's famous fear gauge, the VIX, is calculated from options prices. When liquidity vanished that morning, the machines that make those prices simply widened their quotes, a mechanical reaction, not a human panic. But the fear gauge read those wide quotes as terror. It spiked to 65.73. And that reading triggered other automated funds, the ones programmed to sell when fear rises, to dump everything they held. Machines frightening machines. The result reached straight into American retirement accounts. The S&P 500 fell 3%, the NASDAQ 3.4%, in one session. Not because of anything happening in America, but because someone in Tokyo had made borrowing yen slightly more expensive. And the data on the unwind is almost hard to believe. Speculators had built a record bet against the yen, 184,000 contracts short at the start of July. Within about 6 weeks, that flipped to a 23,000 contract long position, a complete reversal. That is the sound of an entire crowded trade sprinting for the same narrow exit at once. Now, the market recovered in the weeks after. It always does, for a while. But if you were paying attention, August 2024 was not the disaster. It was the rehearsal. Now let me show you a man who watched this exact same setup and did the opposite. In 2020, Warren Buffett started buying stakes in 5 of Japan's oldest companies, the great trading houses, Mitsubishi, Mitsui, Itochu, Marubeni, Sumitomo, sprawling conglomerates that touch everything from energy to food to metals. On the surface, it looks like a carry trade. He used cheap yen. But the structure could not be more different, and the difference is the whole lesson. The hedge funds borrowed yen and bought assets priced in dollars. That means they were exposed. If the yen moved against them, they bled. Their whole bet secretly depended on the currency staying weak. Buffett refused that risk. Here's what he did instead. He didn't spend his American dollars at all. He went into Japan and issued bonds. He borrowed yen directly at rates estimated around 0 to 1%. Then he used that borrowed yen to buy Japanese companies that pay dividends of 5 to 6%. Look at what that creates. His debt is in yen. His dividends come in yen. The two are matched. If the yen rises or falls, both sides move together and cancel out. Berkshire itself described the goal not as a bet on the yen falling, but as currency neutrality. He engineered the currency risk out of the trade entirely. And the math is almost unfair. On roughly 1.3 trillion yen of borrowing, Berkshire's expected interest cost for 2025 was about $135 million. The expected dividend income from those Japanese stakes? About $812 million. He earns $6 for every dollar he owes, and he doesn't care which way the currency moves. Meanwhile, the stakes themselves have soared. By the end of 2024, positions that cost him around $13.8 billion were worth roughly $23.5 billion. So here is the single sentence I want you to keep. Wall Street used cheap yen to buy expensive promises. Buffett used the same yen to buy cheap cash flows. Same fuel, opposite machine. One was a leveraged bet on a currency staying still. The other was a matched, patient claim on real income. And when the ground shook in August 2024, one of those machines was margin called into oblivion, and the other didn't even feel it. Nobody here is smarter or purer. Buffett simply structured his trade so that the thing that destroyed the speculators, a moving yen, could not touch him. Now step back inside Japan, because there's a paradox here that explains everything you've been told about the country being both booming and miserable at the same time. A weak yen doesn't create one Japan. It creates two. For the exporters, Toyota, Sony, the trading houses, a weak yen is a gift. They earn strong dollars selling to the world, and they pay their wages and their rent in cheap yen at home. Translate those foreign earnings back into yen, and the profits look enormous, record enormous. And it wasn't only currency. This is important, and the honest version of the story includes it. Japan's stock exchange forced a genuine reform, pressuring companies trading below their book value to finally return cash to shareholders. Buybacks hit a record 17.8 trillion yen. The market rose on real earnings and real governance changes, not just a cheap currency. The International Monetary Fund tied the 2025 surge specifically to that combination of profits and reform. On May 7, 2026, the Nikkei closed at an all-time record, 62,833. For context, the peak of the legendary 1989 bubble was under 39,000. Japan didn't just recover the ground it lost over 30 years, it obliterated the old record. That's the first Japan, the Japan of shareholders and CEOs and Warren Buffett. Now the second Japan, the Japan of ordinary households. This country imports more than 90% of its energy and about 60% of its food. When the yen collapses, the price of nearly everything a family needs goes up. That's imported inflation, and it has been grinding away at the public for years. The government pushed wages up. It raised the minimum wage benchmark by 6% for fiscal 2025. And still, it wasn't enough. According to Japan's own labor ministry, real wages, what your paycheck actually buys, fell for the fourth year in a row. So hold both pictures at once. Record corporate profits, record stock market, and a population that feels poorer every single year. A booming market on top of a shrinking paycheck. That tension is the real reason the Bank of Japan is raising rates. Not textbook economics, politics. A central bank cannot let its own citizens keep getting poorer to keep foreign speculators comfortable. Something has to give, and the thing giving way is the era of free money. So let's come to right now. As I record this, the Bank of Japan's rate sits at 1% after that June decision. The next meeting lands on July 30th and 31st, days away. Forget the headline that rates are starting to rise. That's already old news. The era of zero rates in Japan is finished. The only question left on the table is how far the Bank of Japan is willing to go. And the market has an opinion. Pricing in the futures market currently implies about an 84% chance of another hike by December 2026, toward 1.3, 1.4%, with some major banks estimating a terminal rate of 1.5 by 2027. Those are market forecasts, not certainties, but that's where the smart money is leaning. Now, why should an American watching this care? Because a rising yen and a rising Japanese yield don't just threaten hedge funds in Tokyo. They pull on two separate threads at once. And this is the part almost nobody explains. The first thread is the one you'd expect: risk assets. If the yen strengthens or Japanese borrowing costs climb, the carry trade unwinds again. Funds buy back yen and sell whatever they bought with it. Your technology stocks, your AI names, sold not because anything is wrong with them, but because someone across the world needs to repay a loan. We watched the rehearsal in August 2024. A second act could be larger because the leverage is larger. American margin debt just hit a record $1.5 trillion, up nearly 50% in a year. And the AI giants, Amazon, Microsoft, Alphabet, Meta, Oracle, are estimated to be issuing something like $300 billion of bonds this year to build their data centers, roughly doubling their debt loads. That is a great deal of leverage sitting on top of a funding cost set in Tokyo. The second thread is quieter, and I'd argue it's the dangerous one. It runs through Japan's insurers, its banks, and its pension money. For decades, these institutions were reliable buyers of American government debt. Japan is the largest foreign holder of U.S. treasuries on Earth. But now Japanese bonds pay over 2.5% at home, safely in their own currency, with no exchange rate risk. Once you account for the cost of hedging the dollar, a U.S. treasury can actually yield less than a Japanese bond. The logic that sent trillions of yen into America for 30 years is simply reversing. And the data is already showing it. In April 2026, Japan's private sector sold a net $46.8 billion of U.S. treasuries. At the very same time, they bought U.S. corporate bonds and U.S. stocks, moving up the risk ladder, not out of America entirely. So it's not a fire sale, it's a rotation. But the direction on government debt is unmistakable. The IMF flagged exactly this. It warned that unwinding the yen carry trade and Japanese investors bringing money home could hit international bond markets, including the market for U.S. government debt. Sit with what that means. Japan has the power to press on the price of American stocks and on the cost of American government borrowing at the same time. And it's doing it precisely when the United States is carrying more than $39 trillion of debt and needs cheap financing more than ever. The threat was never just Japan sells NVIDIA. The deeper threat is that Japan quietly stops funding America's debt. So let me leave you with facts and let you draw your own conclusion. That's the deal on this channel. I don't tell you what to think. Japan is not dying. That was always the wrong frame. Japan is transforming. For decades, it did something almost invisible. It subsidized the entire world's appetite for risk by keeping its money cheaper than anyone else's. Wall Street borrowed that cheapness to buy expensive promises. Warren Buffett borrowed the same cheapness to buy real, boring, reliable cash flow. And now, the subsidy is being switched off. When the cost of money in Tokyo rises, the money starts coming home. And it can come home through two doors at once, the stock market and the bond market. Here's the uncomfortable part for a lot of American investors. Most of them watch the Federal Reserve obsessively and never think about the Bank of Japan at all. For years, that was fine. It isn't fine anymore. The person who ignores Tokyo while staring at Washington is watching the wrong clock. The real pulse of the global market right now isn't only beating in New York or in Washington, it's beating in Tokyo, and it's speeding up. I've laid out the mechanisms, I've given you the numbers, and I've told you which are confirmed and which are estimates. What you do with that, whether you see risk or opportunity or both, is up to you. If this changed the way you see the map, do me one favor. Hit like and subscribe.
Okay, folks, I'm going to provide another perspective ending this video. And the point I want to make is, in 2008, we had the great financial collapse, where all the profits were privatized and all the debts were socialized. Now, you're in a situation where this may happen again because we've had a huge speculative asset appreciation on the American markets, especially in the Dow, under Donald Trump going back to 2016. There's a change in the global markets, and hopefully the people around the globe will get together and not allow for the abuse the U.S. administration is putting on the rest of the world. Instead of working together and creating a place of peace, harmony, and benevolence, they're very aggressive, very abusive to their allies and everyone else for their own benefit. And what we have to worry about now is the Americans actually collapsing and crashing their own system just because of their own actions. And because they created that system, it affects everyone around the world. And Iran is a major. This Iran situation, Strait of Hormuz, has yet to hit home with every Western democracy. And that is how it's going to affect food, inflation, and economies. Hopefully people will understand that there's a different way of creating a framework for an economy that gets rid of this pain and suffering and moves to a state of benevolence and abundance. China has been leading the world in that. China does not have a homeless situation like every other democracy has. And that should be a wake-up call to everyone. So, questions, comments section. Love and peace to everyone. Talk to you all soon. Ciao for now.